How concerning are China's financial troubles, and why does Ray Dalio compare them to Japan's economic collapse? Dalio has observed alarming similarities between China's current balance sheet problems and Japan's asset bubble before its decades-long economic downturn. He points out that China's economy is facing serious challenges, including heavy debt, which could potentially lead to a long period of stagnation, just as Japan experienced. The instability in China's financial system echoes the warning signs Japan displayed before its crisis, suggesting that China may face a tough and prolonged economic future. So, what does Ray Dalio believe will happen if China's financial instability continues? How does China's current economic situation compare to Japan's lost decades? Could China be on the verge of a similar long-term economic decline? The founder of Bridgewater, which is recognized as one of the largest hedge funds globally, has expressed concern over the property crisis in China. This crisis, in particular, has left local governments in a difficult position as they are now struggling to manage their debt. Historically, these governments have relied on land sales to extract equity, but this avenue is no longer as viable. Ray Dalio established the firm in 1975, and it has since grown into one of the most influential and largest hedge funds globally, managing assets worth billions of dollars. Bridgewater is known for its unique investment strategies and rigorous risk management practices, which have earned it a prominent place in the financial industry. Ray Dalio's approach emphasizes understanding economic trends and managing uncertainty, and his insights are often closely watched by global investors. This is why his recent concerns regarding China's property crisis carry significant weight. The crisis has left local governments in China in a precarious financial position, struggling to service their debt. These governments previously relied on land sales to raise equity, but as the property market cools, this once reliable source of revenue has dried up, leaving them in a bind. Consequently, the risk grows that provinces, prefectures, and townships, responsible for managing more than 80% of the nation's public spending, will soon find themselves in need of debt relief or forgiveness. If this happens, creditors will likely face significant losses, often referred to as a haircut, as part of the restructuring process to ease the financial strain on these local governments. This potential outcome not only threatens the stability of the region, but also has broader implications for global markets, given China's vast influence in the world economy. His early stance on China. In October 2020, Dalio urged individuals not to overlook China's ascent, arguing that the nation had firmly established itself as a global superpower. He noted that China had demonstrated remarkable success in various areas, including achieving impressive economic growth despite the challenges posed by the COVID-19 pandemic. With some of the lowest COVID-19 case rates in the world, China also positioned itself as the hub for approximately half of all global initial public offerings, IPOs. Reflecting on his visit to China in 1984, Dalio recounted how high-ranking officials were in awe of basic technology, such as calculators, referring to them as miracle devices. He posited that China had now reached a level comparable to the United States in terms of advanced technologies, and suggested that it might take the lead within the next 5 years. Additionally, Dalio highlighted numerous indicators that favored China's continued progress. He pointed out the increasing number of well-educated citizens and emphasized China's capacity for absorbing and processing data, often referred to in media as the new oil. From an investment standpoint, Dalio painted a positive picture of China. He argued that the fundamentals of the Chinese economy remained robust, with its assets being relatively attractively priced in comparison to those in other markets. He pointed out that Chinese stocks and bonds were currently underrepresented in global investment portfolios, while the U.S. market appeared overinflated. Such a natural shift in pricing could provide China with an additional competitive edge. While he acknowledged that unforeseen challenges could arise, Dalio expressed confidence that China's trajectory of economic reform would persist, leading to sustained prosperity. In a controversial twist, he downplayed concerns regarding human rights violations in China, instead characterizing the government as a strict parent. This perspective has not been without its critics, with many questioning the implications of such views on broader ethical considerations. In April 2024, Ray Dalio took to LinkedIn to articulate his steadfast commitment to investing in China, a market he considers essential for truly understanding the world. This statement came in the wake of a lengthy 4,000-word essay he published the previous week, in which he explored the potential for a 100-year storm in China and cautioned about the risk of a lost decade if Beijing were to repeat the missteps of Japan during the 1990s. In his follow-up post, Dalio robustly defended his choice to remain in the Chinese market during turbulent times, asserting that he is neither a fair-weather friend. He emphasized that investing in China has yielded positive outcomes for him, aligning with his expectations of success. Investing in China has been a success for me in all the ways that I hope to be successful, including demonstrating to investors how they can do well in both bear and bull markets, he stated. He went on to declare, "There is no such thing as a bad market, there is only bad decision-making. I find the markets in China conducive to my style of decision-making." In his post, Dalio highlighted several significant challenges facing China's economy, including depressed asset prices, a widening wealth gap, climate change, and increasing tensions with the United States. Amid these challenges, the World Bank and the International Monetary Fund, IMF, have projected a slowdown in China's growth this year, attributing it to diminished consumer confidence, high debt levels, and a troubled real estate sector. Additionally, foreign investments in China plummeted by 8% last year, raising concerns about the country's attractiveness to outside investors. Nevertheless, Dalio remained optimistic, asserting that China's challenges are manageable by Chinese leaders if they do their jobs well. He noted emerging signs that Beijing might soon implement quantitative easing and initiate debt restructuring efforts. The time to buy is when everyone hates the market and it's cheap, especially when it looks increasingly likely that the economic leadership is about to do something, he advised. He further argued that, like all nations throughout history, China has the potential to restructure its financial system and economy to foster productivity. They can also adeptly manage political, geopolitical, natural, and technological forces, he added. Dalio acknowledged that some investors shy away from China due to geopolitical risks, its classification as a communist dictatorship, the rivalry with the US, and the looming possibility of a deeper conflict between the two largest economies. However, he contended that none of these challenges outweigh the compelling reasons to invest in China. For those reasons, the key question for me isn't whether or not I should invest in China, but rather how much I should invest, he emphasized. Dalio's stance on China has previously attracted criticism, including from US politicians, illustrating the contentious nature of foreign investment in a rapidly evolving geopolitical landscape. Now, let's delve into his current understanding of the Chinese market. China's lost decade. If the phrase lost decade were being discussed by anyone else regarding China, it might not catch the attention of markets or Beijing. However, when Ray Dalio, the founder of the hedge fund giant Bridgewater Associates, issues a warning of a 100-year big storm approaching Asia's largest economy, it's impossible to ignore. Dalio has been involved with the nation's economic landscape and its policymakers for years. Over time, he cultivated strong relationships with Beijing as he sought to expand Bridgewater's presence in the Chinese market. His close engagement with China's leadership made him one of the most vocal advocates for the country, even drawing criticism from US politicians on occasion. At one point, Dalio's enthusiasm for China led to tension within Bridgewater itself, particularly with David McCormick, the company's CEO from 2020 to 2022. McCormick, a Republican who previously worked at the U.S. Treasury Department during President George W. Bush's administration, had different views. He is now a Senate candidate in Pennsylvania. The contrast between Dalio's pro-China stance and McCormick's more traditional U.S.-focused approach highlighted the internal conflict that arose due to differing political and economic perspectives. So, when a seasoned financial expert like Dalio, who has both significant experience and financial power, begins to speak of potential catastrophe for China and compares its situation to Japan's 1990s economic downturn, it's bound to make waves. Dalio's nearly 5,000-word LinkedIn post did just that, capturing attention by outlining the risks that ongoing US-China tensions could exacerbate China's already fragile situation. In his post, Dalio warned, "When there is a lot of debt and big wealth gaps, alongside great domestic and international power conflicts, and/or major disruptive changes in nature, coupled with rapid technological advancements," Dalio's warning appears to build upon Chinese leader Xi Jinping's 2018 comment regarding a slowing economy and growing tensions with a more confrontational US under then-President Donald Trump. Since then, China's situation has deteriorated significantly, with multiple factors contributing to the decline. Some of this decline can be traced back to the aftermath of the COVID-19 pandemic, which disrupted global markets and deeply affected China's economy. Additionally, regulatory missteps by Xi's administration have compounded the economic challenges. Foreign investors who once believed in the promise of a more transparent and investor-friendly China, particularly around 2014, are now much more cautious. The enthusiasm that once defined global investment in China has noticeably waned. When investors, inspired by Alibaba Group's high-profile stock listing in New York, poured money into Chinese tech, they may not have anticipated the turn of events under Xi Jinping's leadership. Starting with Alibaba's co-founder Jack Ma in late 2020, the Chinese Communist Party made it clear who truly holds power. The government's regulatory crackdowns served as a stark reminder to China's billionaires that their ultimate allegiance is not to shareholders but to the party. Against this backdrop, and with the looming threat of deflation, Ray Dalio views China's current situation through the lens of Japan's past economic struggles. Dalio is not alone in drawing this comparison. The shockwaves from China's property market crisis mirror Japan's own bad loan disaster, which Tokyo is still grappling with decades later. While Japan's Nikkei 225 stock average may be surging, even testing record highs, the country's economy is far from thriving. It faces the dual challenges of a rapidly aging population and the heaviest public debt burden among developed nations. The difficulties are apparent in the Bank of Japan's struggle to exit its 25-year policy of near-zero interest rates. Global investors scoffed at its attempt to raise rates on March 19th, and today the yen remains weaker than ever. Much like the balance sheet recession that defined Japan's lost decades, it is China's mounting debt that concerns Dalio and other financial experts. Dalio believes China must hasten its deleveraging efforts and cut interest rates more aggressively than Japan did in the early 1990s. In his own words, this should have been done 2 years ago, and if not addressed soon, it will likely result in a lost decade. Dalio is concerned that China's excessive credit growth is diverting valuable resources and attention away from more critical developmental needs. When debt becomes too large to repay, and when significant wealth gaps exist, the economic cycle tends to reverse, he added. Dalio doesn't pretend that solving these problems will be easy. He acknowledges the complexity of China's current situation, stating, "No one knows how far the pendulum will swing back toward more Maoist or Marxist methods." He goes on to explain that China's leadership traditionally communicates less directly, which, as the country reverts to older ways of governance, becomes more understandable. However, this lack of direct communication could prove to be a significant hurdle as China navigates these turbulent economic waters. The key, of course, lies in whether Xi Jinping makes a significant shift towards more progressive and forward-thinking policies. Over a decade ago, at the start of his leadership, Xi promised that market forces would play a decisive role in Beijing's decision-making process. However, the reality has unfolded quite differently. In recent times, Xi appears less inclined to even allow Hong Kong to retain its status as the capitalist hub it once was. This stance contrasts sharply with the reassurances Xi provided to a high-profile group of visiting CEOs just last week. Among the business leaders who visited Beijing were Apple's Tim Cook, Blackstone Group's Stephen Schwarzman, Chubb's Evan Greenberg, FedEx's Raj Subramaniam, Pfizer's Albert Bourla, and Qualcomm's Cristiano Amon. During their meetings with Xi, they were assured that China remains healthy and sustainable. While these words may have been intended to inspire confidence, the reality is that China's economic outlook could indeed be positive, but only if Xi's administration takes decisive steps to enhance the nation's economic performance. The leadership in Beijing understands what must be done to regain the momentum of reform and avoid the looming threat of a 100-year storm that Ray Dalio and others have warned about. Acting swiftly and with a renewed sense of urgency could reassure global investors that their faith in China's future, placed years ago, was not misplaced. China's challenges with Ray Dalio are just beginning. Ray Dalio, once an unwavering supporter, started to express concerns, and it's clear that Asia's largest economy is facing significant headwinds. To clarify, Dalio hasn't entirely written off the country. However, during an interview in Singapore this week, Dalio acknowledged that China's $17 trillion economy is grappling with some substantial issues as its economic slowdown deepens. There are tangible concerns within China's economic environment, which has become increasingly challenging in recent years, Dalio remarked. He highlighted the sharp declines in both property and stock prices, drawing a comparison to Japan's economic struggles in 1990. In Dalio's view, Xi Jinping's economic policies may lead to a situation even more difficult than Japan's during that era. That said, Bridgewater isn't pulling out of China. Dalio clarified that while only a small portion of the company's portfolio is invested in the Chinese market, they intend to remain there through this uncertain period. He also pointed out that, in theory, China remains an attractively priced market, assuming investments are made wisely, with appropriate sizing and strategy. The problem, however, is that this if grows larger with each passing month. As of August, Chinese industrial production has entered its longest period of sluggish growth since 2021, weighed down by declining investments and weakening consumer spending. These mounting pressures place the burden on President Xi Jinping's administration to implement measures that will ensure China meets its 5% growth target for the year. Yet, Xi's inner circle has been unexpectedly slow in ramping up fiscal stimulus, which has traditionally been Beijing's favored method when economic performance falters. Additionally, the People's Bank of China has been unusually conservative in introducing new monetary support, leaving many questioning the government's next move. This year's obstacles stand as a major test for Xi Jinping's Communist Party, with the nation's 1.4 billion citizens closely watching. The party's legitimacy has long been tied to its ability to deliver strong economic performance, with consistent GDP growth serving as a cornerstone of its authority. This link between economic success and political legitimacy means the stakes are particularly high. The challenge Xi faces is finding a way to restore both confidence in the economy and domestic demand, while avoiding the all-too-common pitfalls of a boom-bust cycle, which could trigger further economic instability. Xi must carefully navigate these waters to avoid the kind of rapid economic growth that leads to unsustainable bubbles and, ultimately, painful corrections. Ray Dalio's recent remarks give insight into the mental calculations he is making to justify the positive outlook he has long maintained on China's future. In many ways, Dalio has been a steadfast believer in China's potential, even in the face of growing concerns. Yet, his recent comments suggest a more cautious tone. Dalio acknowledged the cyclical nature of all economies, saying, "No country should make up such a large portion of your investments that it becomes a dominant part of your portfolio." This statement highlights his broader philosophy on risk management, which is the need for diversification. By cautioning against overinvestment in any one country, Dalio is subtly signaling that even his bullishness on China has its limits, given the current uncertainties. However, it is hard to find another high-profile hedge fund manager who has tied his investment strategy so closely to China's trajectory as Dalio has. He has been one of the most vocal proponents of China's potential in global financial circles, often advocating for a more nuanced view of the country. In a series of essays published between 2019 and 2020, Dalio didn't just express optimism about China's future. He passionately argued that many in the financial world were missing out on a historic opportunity by letting their biases cloud their judgment. In these writings, Dalio often expressed frustration with what he referred to as the persistent anti-China bias that exists among Western investors, particularly in the US. He believed this skepticism was unfounded and, more importantly, a barrier to recognizing China's vast economic potential. One of his most famous pieces, written in October 2020, explored the underlying principles that determine why some nations succeed and others fail. Dalio asserted that timeless and universal truths ultimately dictate the rise and fall of nations. He explained that empires rise when they are productive, financially disciplined, and able to increase their assets at a faster rate than their liabilities. According to Dalio, this typically occurs when nations foster an environment in which their citizens are well-educated, hardworking, and display civil behavior. The intersection of these factors, he argued, creates a foundation for sustainable long-term growth. In the same essay, Dalio boldly compared China and the United States, urging readers to objectively compare the two nations using these metrics. He pointed out that, by these measures, China was positioned more favorably than many realized. His analysis suggested that despite short-term challenges, China's long-term fundamentals were strong. Dalio believed that China's focus on education, productivity, and sound financial policies would enable it to continue its upward trajectory. Furthermore, Dalio highlighted the dangers of allowing prejudice or preconceived notions to blind investors to emerging opportunities. Prejudice and bias, he wrote, have always blinded people to the real opportunities in front of them. This, he suggested, was particularly true for those who remained skeptical of China without fully understanding the facts on the ground. Dalio's advice to those skeptics was straightforward. If their doubts about China weren't based on objective reality, they should clear their minds and reconsider their position. Despite his cautionary notes, Dalio remains one of the few high-profile financiers to consistently argue that China's potential far outweighs its risks, though it's clear that even he recognizes the complexities of the current moment. 1 year later, in 2021, The Wire, a publication established by former New York Times reporter David Barboza, featured a cover story titled "The China Bull." While it is important to note that Dalio has not abandoned China, the founder of the world's largest hedge fund raising concerns is noteworthy, particularly in the current climate of intense anxiety regarding China's economic trajectory leading into 2025. This anxiety encompasses deflationary pressures reminiscent of those that Tokyo has been wrestling with for 3 decades. Investors find themselves in a state of confusion, partly due to the widespread belief in President Xi's economic prowess. During the initial 10 years of his leadership, there was much talk about reducing the state's influence in the economy, fostering a surge in startups, creating fair competition, and driving growth through domestic demand. However, these ambitions were largely unmet, resulting in minimal tangible progress. A series of significant miscalculations since 2020, such as severe COVID lockdowns, stringent crackdowns on technology companies, and painfully slow responses to a housing crisis, have compounded these issues. Currently, the deteriorating outlook for consumers in China poses serious challenges to the fundamental beliefs guiding the government's economic strategy. Andrew Batson, the director of China research at Gavekal Dragonomics, commented on this shifting landscape. Since the significant property market collapse that began in July 2021, he observed that the government has mostly allowed the real estate downturn to continue without substantial intervention. Instead, the focus has shifted toward industrial policy, aimed at nurturing new sectors for future growth. Batson pointed out that the housing bubble had clearly spiraled out of control. An adjustment was necessary, whether sooner or later, so it makes sense for it to happen sooner. According to his analysis, once the housing market undergoes its necessary correction, the economy could potentially be positioned for a revival driven by increased domestic consumption and the export of innovative products and services. However, this optimistic outlook becomes increasingly unlikely if household spending does not remain steady during the adjustment of housing investments, leading to a downward drag on the economy. The Chinese housing market crash, which began in mid-2021, has had far-reaching consequences for the economy and the lives of millions. Prior to the collapse, the real estate sector had been a critical engine of growth, accounting for a significant portion of the country's GDP. High-profile developers like Evergrande and Kaisa amassed staggering debts while aggressively expanding their projects, often relying on pre-sales to finance construction. When the government imposed new regulations to curb excessive borrowing and speculative investment, part of a broader effort to create a more sustainable economy, many developers found themselves unable to meet their financial obligations. As a result, a wave of defaults swept through the industry. Evergrande, one of the largest property developers, owed over $300 billion and became emblematic of the crisis when it missed payments on its debts. This led to a halt in construction for countless projects, leaving many buyers in limbo, waiting for homes they had already paid for. Reports indicated that millions of unfinished units littered cities, contributing to growing public frustration and eroding trust in both developers and the government. The ramifications extended beyond the construction sites. Consumer confidence plummeted as household wealth tied to real estate diminished, leading to reduced spending on goods and services. A study showed that the average home price in major cities dropped significantly, causing homeowners to feel less secure financially. Additionally, the banking sector became increasingly cautious, tightening lending practices and affecting credit availability for consumers and businesses alike. Local governments, which had relied heavily on land sales for revenue, also faced financial strain as property sales slowed. This created a domino effect, with municipalities struggling to fund public services and infrastructure projects. The situation has prompted the central government to introduce measures aimed at stabilizing the market, including interest rate cuts and policies designed to support homebuyers. But the path to recovery remains uncertain. The question remains whether the leaders surrounding Xi can effectively break this challenging cycle. The answer is uncertain. This sentiment resonates with Dalio as well. The fact that one of China's most prominent and affluent advocates believes there are real issues concerning the path ahead does not bode well, especially given the current economic climate. Such concerns signal potential difficulties that may lie ahead for the nation's economic recovery and growth strategies, indicating that the road to stability will be fraught with obstacles that must be navigated with care and foresight. With that, we have reached the end of today's video. If you have this far, be sure to check out other videos on the channel.